Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stenevec on Bloomberg Radio.
This is Bloomberg Businessweek, live at Future Proof in Huntington Beach. Today's show is sponsored by Van Eck, celebrating 70 years of helping investors stay ahead in a world that never stands still.
All right, I want to get to our guest because you love a guest who's bopping to the music, our lead-in music. Lauren Goodwin is with us. It's been a while. She's economist and chief market strategist at New York Life Investments, though very much well-known to the Bloomberg audience. She's here with us at Future Proof. How are you?
I am so energized being here. I'll say one of the biggest questions we've been discussing on the desk lately is you're a week away from a 25 basis point Fed cut, and that's a minor reduction in the cost of capital, but does it foster sort of the confidence that you would need to see to get the M&A market back moving, et cetera? And sitting in sunny California with a bunch of registered investment advisors, and the answer would be yes. It's an optimistic crowd. Yeah.
25 basis points? Is that what you think?
Yeah, that is what I think. And to be honest, I think it's the right call. I think it's what they'll do, but I think it's the right call. There's, just enough evidence to the downside on the labor market that I think an insurance cut in every way is probably a good idea. But 50 basis points, look, I don't think that we would necessarily get the market expecting that's the reason why then you have a blowout in inflation expectations or whatever the case may be. But I'd be worried enough about that not to try and mess with it.
So then what's the path into the rest of the year and into early next year?
So I don't know. I would say where we are.
I love the honesty.
I was just going to say, thank you for saying that.
Yeah, exactly.
I will say that, if our view is outside of consensus in any way, it's that I am actually not convinced that we'll have a consistent cutting cycle from here. I think it would be fantastic for the market, and for housing, and for, in some senses, the real economy, for M&A, et cetera. But I look at, yes, the inflation risk, and I think we might have a little bit of an upside surprise on Thursday. I don't think that'll derail the Fed next week. But really what I'm thinking a lot about lately is the upside risk to wages. So in the labor market, part of the attention that the labor market's gotten lately is Powell sort of saying, hey, we're actually quite focused on this in terms of our reaction function, the sort of reduction in demand, the cracks we're seeing. But there's a reduction in labor market supply as well. And so I think we might have several months, maybe even a couple of quarters, where there's just not a lot of job creation, but wage growth stays exactly where it is, maybe even moves higher. And that's just a mix of risks where I think, if financial conditions stay loose, they're so loose right now. Equity market valuations are high, bond market valuations are high. There's not a lot of evidence that you need aggressive cutting yet.
Well, that's what I was going to say. Why do we need to cut rates?
I am just concerned enough about what we've seen from the jobs reports lately, where again, I think an insurance cut, and I am really thinking about it as an insurance cut. I think you would so much rather do 25 basis points and then not move for 6 or 9 months.
So it could be one and done for a while.
It could, and that's why I say, I honestly don't know. It is so boring, but absolutely true to say that we have to be data dependent on this. I think there's people are so used to uncertainty after the last few months that they're saying tariffs don't matter, it's one off, and the labor market is, and I just don't think anyone can actually feel confident about those things.
Can people feel confident about the independence of the Fed?
For now, the market is telling us yes. And
we're going to talk with Barry Ritholtz about this in a few minutes, because I'm a little confused about why the market is so confident. But go ahead.
So as we know, the Fed's credibility in fighting inflation is probably its most important policy tool. And I think what the market is seeing when it looks at this environment is interference in who the personnel on the Fed might be, but a trust that those people are serious. That the people who are taking these seats, though, perhaps have a different political leaning or what have you, understand how Fed policy impacts the markets enough to take it seriously. That's the market's read. And that is so important. It's so important because I think what investors, and it's so interesting to me because the most sophisticated institutional investor will look me in the eyes and tell me, well, when there's change in personnel and we have 150 basis points of cuts, none of us should want that. None of us should want that in this economy because you could very easily see an environment where the policy rate is moving lower and long rates are moving substantially higher in that circumstance. If the market says, wait a second, that doesn't make sense. I think we have just enough data right now to thread that needle to say, okay, look, 25 basis points, that makes sense, et cetera. If the Fed moves too quickly, we lose that confidence. And so it's another reason why I just really don't see an aggressive cutting cycle, again, when financial conditions are so easy.
I think that's a really incredible point. I also, you are... You've got a master's degree in international economics from Johns Hopkins, and I was looking at some of the notes that you shared with our producer, Ari. You are thinking about the future state trends, and one of them is the redrawing of the global map. How would you describe kind of that global map today?
So a couple of things I think are really important about this. The first is that when I talk about redrawing the global map, I'm not really talking about trade, although I think trade policy is an accelerant of the trend. We have seen over the last at least 10 years, some build of policy change in the U.S. and elsewhere, such as competition over the technology supply chain. But an acceleration of that because COVID made us all realize that actually having access to vaccines and computer chips and a couple of other things is really important, right? And so there's been this understanding that the U.S.-led sort of singular economy is changing. The U.S. will continue to be incredibly important in this new regime, but that new regime includes more players and in a way that is getting a little bit trickier to access. So if you think about, one way that this idea manifests is does that mean you should add international equity? And for a U.S. investor, they've been underweight international equity for 15 years and with good reason. But now it's not only your day-to-day political risk trade that people think about that you would want to diversify, but it's also, the last 6 months is a perfect example. Europe has been much more consistent in their interest rate cutting cycle, and they've been investing in defense. And so we've seen financials, industrials, all of the sectors that have their ebbs and flows in the U.S. just consistently outperforming. That's a type of diversification and sort of cycle adjustment.
Does that continue? And you think that continues?
I think that the pace of outperformance on the international trade for the next 6 months, I think that pace slows substantially relative to what we've seen. But the reality is that at the last 10 years, you've had a global economic cycle that is dominated by the U.S. And we now have diverging economic cycles in addition to some of these, geopolitical and trade-related trends that mean you can access not just different, currencies or regions of the world, but different sectors in a way that I think is really interesting.
Come back. We want to continue this conversation. We'll catch up in New York. We hope. Lauren Goodwin, economist, chief market strategist at New York Life Investments here at Future Proof.
I think we're all going to stay here. Are we going back to New York?
Oh, we forgot to tell the team back in New York. Yeah, we're not coming home. No, we're coming home.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, we want to get back to some of our guests here at Future Proof. First of all, I want to just kind of set up this because there's a big trend that's picking up some momentum, and this is as big U.S. banks are increasingly partnering with asset managers, big asset managers. Just last week, Bloomberg reporting out that Citigroup is entrusting BlackRock with tens of billions of dollars of clients' investments in a move that will close the bank's only remaining in-house asset manager and really outsource more of its wealth units offerings. In a new partnership, BlackRock will manage the assets of thousands of the bank's wealthiest clients who currently have accounts with Citi Investment Management. Our next guest is involved with all of this and so much more, and they have a new retirement survey out. Joining us is Jamie Majira. She was named head of U.S. Wealth Advisors advisory in July. Her job includes heading up retirement at BlackRock. It is the world's largest asset manager. They had I think $12.5 trillion, record amount in assets. That was according to the latest quarterly update. How are you?
I'm great. I mean, we're at the Future Proof Festival. Like, it doesn't get better than this. This is beautiful.
It's pretty amazing, right? To talk about like kind of what's going on in the markets against this backdrop. I want to ask you though about the news last week. You were definitely quoted in one of the Bloomberg stories. It was exclusive. You said this is a sector-defining moment. How come?
Well, you know, the thing that I find so interesting about the wealth market is that as firms are getting larger, right, as wealth management firms, as banks, they're getting larger and they're looking to really lean in on what they do best, which is serving their clients, expanding their relationships with their clients. And as they do that, they need to work with partners who can be their outsource provider, who can take on the investment management, who can build custom solutions for them. And so this is just one example of a very large global bank selecting BlackRock to be their outsource provider. But we're seeing this every single day from financial advisors all around the country. They're looking to work with firms like BlackRock so that we can customize solutions for them and take on the investment management so they can do what they do best, serve their clients, expand their client
So this is
reach.
just the beginning of a lot more to come.
Just the beginning. So much more to come.
I was just going to ask, should investors expect more of these partnerships to be announced?
Absolutely. Absolutely. And by the way, today, BlackRock has over 30,000 financial advisors just in the U.S. who are already relying on us to be their outsourced provider. Then you enter a firm like Citi, a massive global bank. There will be more firms coming who are going to come to BlackRock and ask for this type of partnership.
So you guys see a lot. How would you describe the investment environment? We were just talking to Matt Middleton, who puts on this event, and said last year it was all about the upcoming U.S. elections. They've happened, right? And we have a president who's very active on things that really impact the investment environment. How would you describe the environment today?
Look, I think a lot of people, with reason, of course, have uncertainty around economics, uncertainty around tariffs, uncertainty around everything and what that means for their portfolio. What I find most positive and exciting is the fact of all of these people who are thinking about, what does this mean to my savings? What does this mean to my ability to retire? What does this mean to my ability to send my children to school? Well, they're working with professionals like financial advisors, like so many of the advisors that are here. And the job of the advisor is to help them navigate that uncertainty and help them focus on the long term, right? It's about time in the market, not timing the market. And that's something that we believe very strongly.
What are the questions that they're asking right now, especially the wealthier clients? What do they want to know? What do they want to invest in? What opportunities do they want you to provide?
Yeah, there's two massive things. One is taxes. Help me better manage my taxes. I can control for that. I can't control markets. Help me better manage.
It's so funny that you say that. I feel like all of a sudden we've noticed too, I think in conversations that it's yes about returns, but it is about tax
alpha
advantages. Yes, exactly. Tax alpha. So go ahead. Forgive me.
But you're right. That is top of mind for high net worth, ultra high net worth investors because one, they can control it. Two, there's actually a pretty significant implication on their portfolios when you think about taxes. And so it's exactly why a few years ago BlackRock acquired a company called Aperio. Aperio was a direct indexing company, a platform that had best-in-class capabilities to help end investors customize portfolios, right? Single security portfolios maybe for their values, their beliefs, most importantly, their taxes. And today, that's one of our largest growing platforms. Aperio direct indexing, also SpiderRock, where you can do custom overlay, custom options overlay. Think about that Apple executive that worked at Apple for years and years and years and has all of this Apple stock. That's emotional for them. They want to hold on to that. There's a lot of tax implications in that. But at the same time, they can hedge against that. They can run options on top of that. And that is top of mind.
Okay, so taxes was one thing. What's the other one?
Private markets.
Yeah, I knew you were going to say that.
Of course you did. Private markets, every headline.
What part of that specifically? When you think of alternatives, when you think of private markets, where?
Yeah, so let me take a step back and say one of the things we believe very, very, very strongly at BlackRock is our job is to help make it easier for investors to access the full power of the capital markets. Now, previously, capital markets meant public markets. We know the opportunities that exist beyond the public markets in the realm of private companies. And so it's why last year we acquired Preqin from a data perspective. We acquired GIP, HPS, because we feel so strongly.
Preqin being, I know, for those of us in the journalism world, I mean, that's where we go in terms of for data on the private markets.
Every slide, every chart you see, source Preqin. And it is really the only source of of truth on private markets. And so if we have that in addition to all of these capabilities that help us build products that allow people to more efficiently access the private markets, then we can better serve our clients in the wealth market, not just institutions any longer, and also in retirement.
We're talking with Jamie Magira, Managing Director, Head of U.S. Wealth Advisory and Head of Retirement at BlackRock here at Future Proof in Huntington Beach. We reported, too, that I think Larry Fink, your CEO, has talked about, and your CFO, about offering target date retirement funds that include private assets next year. I mean, it meshes kind of with the survey that you guys put out today that talks about 24% of retirement plans are considering adding alt assets over the next year, private equity, credit, and other investments. Is that still on track? Can you give us an update?
Yeah, absolutely. So yes, it is still on track. Look, I think there's been a lot of headlines from a lot of different firms about people coming to market with ideas of how to incorporate private markets
safely, right? Because we have to remind everybody they're not as liquid as a lot of investments that normally your retirement funds go into.
Yeah, there are many considerations that plan sponsors and investors need to think about to make sure it's right for them. Our view is that if we can do this thoughtfully, strategically, integrating private markets, private assets, into a target date fund alongside of public markets and manage that glide path so it's appropriate for people at different stages of their life, then we can actually deliver them 15% more returns over a 40-year, or 15% more retirement assets, I should say, over a 40-year time horizon. That's a long time, and that's a lot more retirement savings. And so we believe strongly in that. We are on track. We actually are already in market as well in the smaller and mid-sized retirement space. So we partnered with a company called Great Gray, and we're powering their glide path so that they can incorporate public and private markets into one target date solution.
Do you know, when we think about target date solutions now, what we know and what we've experienced is like the asset allocation between equities and fixed income. Do we get to a point where that's not even a choice anymore? It's like equities, fixed income, and privates?
It's interesting. I think for so long, people have thought about the 60-40 portfolio. Equities, fixed income. Some people may be as bold we are to say 50-30-20. That 20% might be 10% private equity, 10% private credit, different diversified assets in there. But absolutely, I think the new portfolio, the portfolio of the future to fund these longer lives has to incorporate private assets.
You know, one of the things out of your survey that I thought was really interesting was guaranteed income is now a top priority. 86% of workplace savers want it. And for the first time, 100% of employers say they feel responsible for helping participants generate income in retirement. I keep thinking about my father who had a pension and VA benefits and investments, and not a lot of people are doing pensions, right? Or anything anymore. And so I am curious about how employers are thinking about this. That struck me.
Yeah, so it's so interesting because you raise such a good point. So employers used to have pension plans,
right?
And then the conversion to defined contribution. Well, we're now seeing pensionization of defined contribution. Think about private assets have been available in pensions for decades. Well, now they'll be available in 401k plans, retirement plans. Same thing with guaranteed income. That's what the benefit of a pension was, but there's no flexibility around that. So BlackRock has created a solution. It's a target date fund solution. It's called LifePath Paycheck. And what it does is it actually delivers you the option, the choice to have guaranteed income. You can choose to take that or not, but it's giving savers and employers the option to have their employees have more security, have more simplicity, have more confidence in their retirement income. One of the things I'll just add is that I found so interesting in our survey, when you look at retirees, 27% of retirees, only 27%, are confident in their ability to live through retirement on their savings.
Well, that's discouraging.
It's discouraging.
Well, so what's the implication of that, just in the last minute that we have with you? Because that has implications beyond our own portfolios. That has real societal implications.
It has societal implications in that there's going to be this whole group of Americans who are trying to live through retirement. Maybe they do another job. Maybe they spend differently. That shouldn't be the case. Longer lives should be a blessing. They shouldn't be a challenge. And that's where guaranteed income comes in. That's where the modernization of 401k plans to include private assets comes in. And that's where more advice comes in, which is why we are here at Future Proof Festival. Advisors play a massive role in this.
All right. And you're going to be part of a panel a little bit later on today that's all about the state of investment management, where we're headed next. There's a lot of things I know that you guys are going to roll into that. Jamie, thank you so much.
Thank you. It was great being here.
It's great having you. Jamie Magira, Managing Director, Head of U.S. Wealth Advisory and Head of Retirement at BlackRock, joining us here at Future Proof.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Treasury is seeing some mild gains today. 2-year yields remaining at the lowest since 2022. The U.S. yield curve further to steepen should the Fed unleash aggressive interest rate cuts. That coming from Double Line Capital's Bill Campbell. There's a lot of conversation and narrative around what the Fed's going to do and the impact. Let's see what Priya Misra has to say. She's Core Plus Bond ETF Portfolio Manager over at JPMorgan, joining us here at Future Proof. Good to have you here. Just a little bit of stuff going on. Curious how you are looking at the path of rates for the U.S. economy. What you're thinking around this?
Thanks for having me. You're right. There's a lot going on. And if you think about everything we've had to deal with this year, tariffs, Fed independence, the deficit, it's just, and then you look at equities at their highs and now bonds doing well. So what's going on? So our view is everything's actually consistent with a soft landing. What I actually think equity people call soft landing and bond people
Which
call
is
soft
lovely.
trend growth. Yeah, the growth in the 1 to 2% range. Inflation's a problem. It's not at 2%, but it's not as high as people feared when we first heard tariffs. So it's allowing the Fed to start to cut rates. And then we've had this slowdown in the labor market. I think the hope is it stops right here. This low fire, low higher. We don't quite make it to the high fire world, that the Fed can cut just enough in terms of time as well as how much they cut to get the economy to stay in the soft landing mode. I think that's the hope.
Why are you so confident that the tariff-induced inflation that we've seen has not been as prominent as people initially thought it would be? We just had Barry Ritholtz on. He said, hey, a lot of people pulled forward. A lot of companies pulled forward, so the tariffs hadn't hit them yet.
Right. And so I think that is the risk scenario, but I'll get to your question. So it hasn't happened yet. Now, again, we're looking at the future, and maybe it can happen because I was using inventory, and now when I'm paying more as a company, I can pass it on. Here's the issue. Companies are realizing that consumers are cost conscious, and passing on price increases entirely runs the risk of consumers stopping buying or reducing the amount that they're buying. So I think that's why companies might be taking some of the tariffs in their margins. Margins are high, so they can afford to take some of the cost in the margins. Some of it, the currencies work. Some of it, maybe the foreign producer is taking some of that hit. So I think that through the value chain is being absorbed at different spots. But the other part is look at the rest of inflation. So maybe goods inflation does pick up because companies have to pass on at least some of it. And Governor Waller thinks about half of it will be passed. Some people argue 1/3. Some part is going to be passed. Look at, the U.S. consumer basket is really 75% services. So we're looking at service inflation, wages, rent inflation, ex-rent, core services. That it's not coming down, but it's not going back up. In fact, wages, we're seeing signs that wages are starting to slow down. So our thought is even if you get the goods-related price increases, services will likely offset it. And that's why Chair Powell, something he said in Jackson Hole, which I thought was the first time I've heard it in a while, that it could be short-lived, meaning that they can look through any tariff-related increases. Now, it has to be tariff-related. So let's see, we get a CPI report later this week. Our view is services is going to not be as troublesome. Goods might look troublesome, but they can put it down as one-off.
It sounds like if things aren't so bad in terms of inflationary pressures, and if you, as you kind of laid out in terms of the jobs report, maybe it was just that 1 month, that we're not going to continue to see losses. Why do we need to cut rates? Is it just I keep hearing, no, I shouldn't say keep, but the idea of an insurance cut just in case. Is that what this is all about?
So I think the starting point is where I focus on the starting point. We're in restrictive territory. If we were at neutral level,
even though financial conditions are really loose, like you.
Yeah, but interest-sensitive sectors. Look at housing, look at consumer durables. So sectors of the economy that are sort of levered to interest rates are in a weak spot. So that's why that restrictive level of interest rates matter. And if the Fed sees...
But it's not the Fed mandate, right? Like when I think about interest rates to help the housing market, all I can think about is the financial crisis. And I realize there were a lot of things going on at that point, Priya. But I do wonder, is that what the Fed needs to be concerned about?
So I think they've got other tools for it, whether it's regulation or making sure that, banks are not lending to, remember the ninja loans back then, the no income job.
No job.
Right.
Yeah.
Or assets. That was what the A was for, and people were getting loans. So I think there's other ways to ensure that there's not excesses. But when you look at the one tool that they have, interest rates, we're in restrictive territory. Inflation slowly heading down, which is impressive given the extent of tariffs. Average effective tariff rate is 15%, and yet inflation's not accelerating. And the job market is slowing. I think why Chair Powell was a little maybe hesitant in July wasn't sure is it demand or supply. And it's both factors are impacting the labor market. But there's clear evidence, I think, that the demand side is there. Demand is slowing. You're seeing it in college age, the unemployment rate. For young people, you're seeing it in hiring plans.
That was pretty stark on Friday. We talked about that. The numbers that we got for young people. I mean, anybody can speak anecdotally about this who has young graduates from college or young people in their household. It's not pretty out there.
And that's why it's hard to put that on immigration. There's absolutely an immigration impact on the labor market, but not when you look at the young people who are not getting jobs straight out of college. So I think there's a demand aspect. Now, is it AI? Is it tariffs? Is it uncertainty? Hard to disentangle what's driving it. But there is a demand aspect. And so I think the Fed is looking at that and saying, well, let's reduce some of that restrictiveness. I think talk of 50 basis points cut next week, might be a little aggressive. Because I think that is in case you see signs that layoffs have really picked up. We do have an initial claims report, one report, that really spikes. I think we can talk back about 50. They don't have to get aggressive, but just start that process and remain data dependent.
What do you think the revisions on the labor data tomorrow? I mean, we've been so focused on that. What do you think that's going to show?
It's going to be between 800,000 and 1 million. So it's going to be a big number down. I don't think it should be a big surprise. The labor market was the outperformer when we looked at everything else. So I think the fact that these revisions will actually bring the labor market in line with GDP, in line with consumer spending. And so, and is it, I don't think it's political. I think it's just data collection has been an issue really since the pandemic and globally. You look at response rates globally, it's something we should all think about. How do we get more accurate data? And I think this is, maybe revisions is the way to do it.
Well, Mike McKee was talking about this, and he says, people are responding. The responses are slower. And so that the revisions finally take all of that into account. So how do we get people to respond more quickly, right? So that the data is more relevant in a timely manner.
Yeah, maybe you're supposed to spend more money, figure out some modern way of asking people questions.
Think called technology, maybe. I'm just saying.
Speaking of that, I'm curious about the immigration side of things and the way you're looking at immigration from your perspective as somebody who invests in fixed income, recommends fixed income, and thinks about strategy, because we're seeing a real crackdown, obviously, here in the U.S., and that has implications for labor market. It also has implications for demand. Augusta Saraiva, who writes for our economy team, had this really interesting piece out over the weekend about Hispanic consumers hitting the brakes as U.S. firms warn of a pullback. So now we're starting to hear U.S. firms talk about this segment of the population spending less as a result of an immigration crackdown. How are you looking at that?
Yeah, it was a great article. I read it and it sort of hit a nerve because a lot has been talked about immigration and the impact on the labor market. What about immigration and growth? It's a source of demand, housing, consumption in general, and this idea that R-star. So I'm going to take it down to, I'm a bond PM, so I live in the R-star world.
We love this.
But what is neutral interest rate? And there's been this argument that actually neutral rate is maybe it's 3.5, maybe it's 4. You didn't ask me, but there are people who tell me we're at neutral. Stock market's high, we're at neutral. Fed doesn't need to cut rates. And then I say, look at the interest-sensitive sectors. They're all kind of frozen, slowing. Yeah. So it is restrictive. But what is that neutral rate? I think immigration was a big part of why that neutral rate has gone up. Like in 2010 or 2008 to 2020, we argued the neutral rate was 2.5. Now people are saying maybe it's 3.5. How much of that is immigration? And so if immigration is heading low and this is a structural trend, then I would argue maybe that neutral rate is low. And so where should the 10-year be in equilibrium? 3.5 to 4 seems fine. In a recession, it's going well below 3.5. But we're not pricing in a recession. So I don't see a disconnect between bonds and stocks. They're both, or spreads for that matter. They're all telling you an okay economy, Fed cutting just enough, and hopefully we just stay here. But if things slow down more, well, then the Fed's going to cut a lot more. Then that 10 years getting much lower. So I bring it to whether it's consumption or the labor market, that immigration impacts that neutral rate lower.
Priya, just got about 30, 40 seconds here. So you add all this up, there's your macro. What does it mean for investors in the fixed income world? Where should they be allocating assets?
So fixed income should give you income and diversification. It's giving you both right now. In income, in real terms, the 10 years giving you 2% real rates, 30 years giving you even more. So I would say own fixed income for yield, and then you have to go out the curve. Diversification is where that curve comes in. You need a little bit of duration. I don't know anybody who's long the 10-year. Well, I know myself. We're long a little bit of the 10-year. A lot of people are nervous about the deficit.
Right.
The deficit is better today because of tariff revenues. So I think it's priced in. You're getting paid to extend. Take a little bit of credit risk. Own some duration. The economy is okay, so you can look at fixed income for that income. And if you've got, what role does fixed income play in a portfolio? If you've got risk assets, you want to hedge those risk assets, own a little bit of 5-10 year duration. Don't have to go further out, but that's where you'll get that diversification benefit.
All right, great stuff. And so tell me, Priya, thank you so much. Always appreciate time with Priya Misra. She's Core Plus Bond ETF Portfolio Manager over at JPMorgan, joining us here at Future Proof.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, there's so much going on behind us. 5 stages, 6 football fields worth of boardwalk, 5,000 plus attendees, financial advisors, wealth management execs, limited partners, around 100 sessions featuring over 200 speakers. There's a lot going on, and it represents about $20 trillion in assets under management. So this is why it's a great place to be. Behind it all, the reason we are here, the reason this exists is Matt Middleton. He is with us, founder and CEO at Future Proof, joining us here on site. I should point out, former growth strategy director at Informa, co-creator of the financial advisor conference WealthStack, and recently, along with a partner, acquired a majority stake in ETF.com. So you got a lot going on here.
Been busy.
Yeah, you are busy. Tell us about how you think about the financial space and what advisors today really need.
Yeah, so I think it's 2 parts, right? We all grew up. My personal experience into the industry, it was conformity, right? It's, talk this way, walk this way, dress like this, act that way. If you want to get in that room, this is where you have to be. And really, what we're representing here is a shift, right? It's a mindset shift. It's a generational shift. And what we're seeing is that people with real buying power, real influence and assets want to actually break up of the status quo. And this is a representation of that new industry, which is not just casual attire. Obviously, we're here on
I know we feel a little dressed up here.
I said earlier, I'm the only one here wearing a suit.
I know, that's first timer, that's why.
Yeah, that's what happens. You can tell who the first timers are, yeah.
But it is. It's mostly about the experience here and people connecting. And the industry is better when we all connect versus siloing out. And so our hope is here is not just to define it as wealth management, not to define it as asset management or fintech. It's to bring everyone together from all job levels across all functions and give them the tools that they have to meet and network to see how to build a better business.
One thing that I noticed about this conference that I've never seen before is for a small fee, you can bring your partner, meaning your husband, your wife, your boyfriend, your girlfriend, your significant other. I've never seen that before. What's the thinking behind this?
Well, personally, obviously, I'm an entrepreneur, and, I always laugh when I have these conversations. Everyone's like, what's the vision? What do you do this? How do you manage it? You just acquired this business. And at the end of the day, it's like, my co-founder is my wife, right? At the end of the day, it's who you have at home, the people that are on that journey with you, that kind of wear all of that. And so part of that view was, one, we're in this beautiful setting, right? It should feel like a destination and a vacation to some sorts, but also it's allowed to you get your spouses to experience what the industry is like, meet your clients, meet your partners. And again, I think if they are more exposed to it, they'll understand it more. And that's a representation of what we're trying to do here, which is if we could get this event to a large enough scale and get national attention with the help of you all, well, maybe some people on the general public will start to look at it and say, oh, what is this, right? They'll scroll through Instagram and it's like, oh, I see Coachella and my friends, and this is it's a cultural movement. And then the next scroll, they're scrolling and they're seeing future proof, like, oh, this is great. What is a wealth management conference? This is interesting. What is wealth management? And we could expose them to more of it. And so it's a little bit of one, we want to make it family oriented, and the other side of it is we want to change the narrative and the optics of our industry.
But do you also think about, I thought I read somewhere too that you want to kind of cap how many people are here, because we've certainly been to lots of conferences where it just feels like thousands and thousands and thousands of people and tons of booths, and it's almost overwhelming. Yes. And I'm not quite sure what the takeaway is.
Yeah, so it's two parts, right? One is, yes, that is true. When you get a large crowd, the word that always comes out is boondoggle, right? And you have no mission, people get lost, you're drinking from a fire hose. We use proprietary event technology, so Breakthrough, what you see this big tent here, to allow people to connect in meaningful ways. And the goal there is you go into the event, so 3 weeks before the event, you basically are making connections and guaranteeing certain meetings. So you have one-to-one meetings, you have roundtable discussions, you have all these different booth activities. These are all pre-scheduled. So it's not serendipity happens. So you could create a large-scale experience, multi-thousand person experience, and create a unique agenda and a unique networking plan for one specific role or person. And that's the benefit of what we do. The second side to that is we do want to cap this because there's a magic size here, and we believe that's around 5,000 people. One, we're in 4 hotels in Huntington Beach. We have 10 hotels in Newport Beach. People staying in Irvine. There's people staying 40 minutes away. So at some point, even if we can't control it, their experience is going to be different than everyone here. Yeah. And so we decided that there's a limit to what we want to do here. I
did see this idea of, growth and bringing people. I did notice that pretty much everything is branded. There's sponsors everywhere. From the perspective of this as a business, in terms of revenue, is your biggest revenue source still tickets, or is it sponsorships now?
It's always sponsorships. So
how much bigger is that than tickets?
It's probably 70-30 ratio. We also monetize all these different connection points. So again, using the technology, right? A lot of these meetings that you see, some are peer-to-peer, others are, buyer seller. And so there's different ways to monetize events that we've kind of broken. One, it's a different format, right? Two, it's the technology allows us to do things differently than most other events. But yeah, the idea here is like events should be about the community and shouldn't just treat the attendees as a product, which is unfortunately how it typically happens when you have these booths and everyone's trying to pitch and wheel. And so you see people that you see a lot of the big brands that you see at other events, but they're showing up differently here. And it's meaningful. They get better ROI and the attendees have better experiences.
So, been doing this a few years, post-pandemic. I remember last year, Matt, that such a big theme was the upcoming U.S. elections. Well, they've come and gone.
Yes.
We've got a president in the White House that definitely markets and investors are focusing on. We are certainly, because what he says and what he does certainly impacts the investment environment. What is top of mind for the folks as you are moving around talking to folks? And are people more optimistic this year than they were last year? Any takeaways so far?
I think people are optimistic. But I also think people are not sure of what the future is. And that's for a whole host of reasons, like AI being the biggest narrative in this year's event.
Which is a big theme, right?
Of course. It's the big event. And you could look at it from all different sides, right? From an investment side, right? You have to understand what is going to be affected into the future, right? Not just what it is today, but what is AI going to do, and not just to tech companies. What is it going to do to various different sectors, right? The other side is the operational side, the industry side, right? It's a rewiring of our entire industry, and it's going to be a new operating model for wealth management specifically. And most people here are trying to figure that out, right? Most RIAs, which are a large majority of the audience here, they're small business operators, right? And so at the board level, they're having these discussions, right? How much do we need to invest in AI? How do we understand it? How do we use it? What's our audience going to look like into the future? Are we going to serve clients directly, right? There's so many different questions. And the truth is, even the AI experts today, no one knows because it's changing so rapidly. Every 6 months, it's a new shift.
Yeah, and at the same time, so much money, right, is being invested to the infrastructure build-out and just overall. Matt, thank you so much.
Absolutely.
Thanks for inviting us. Really appreciate it. Matt Middleton, he's the founder and CEO of Future Proof, joining us here in Huntington Beach.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.